It is my honor to introduce my father, Mike DiMatteo. My father has over 30 years of investment experience now. He is co-founder and CEO of 1015 Associates.
Tonight's presentation will be archived and online. I'm probably going to go over a couple of things that most of you already know, but we're going to set this up so that people can view the website and learn more about us, so I appreciate your patience. The first thing that I'd like to talk about is just a little bit of history of the company. As you probably realize, we started October 15th in 1986. Very bare minimum start. We started in our basement. My father helped redo the basement, and I wish you could see this today. We started with 2 desks, 2 phones, a very empty file cabinet, and 2 young dreamers in their 20s. Tonight's speaker graduated in 1985, magna cum laude, Stern Business School of NYU, with dual degrees in finance and economics. While she was in college, she also attained her insurance license. After graduating, she sat for her Series 7, Series 24 license. Soon after that, she was ready to take her certified financial planner license. She passed the qualification exam 2 weeks before the birth of our first child. 2 others would follow right behind. I like to say Debbie did everything right on schedule as usual. As the years passed, she found her true calling. She became the lead portfolio manager for the company. Her strategies got the firm and our clients through one of the worst times in the history of this country. Currently, the company manages over $570 million, I'm proud to say. Now we have quite a few cabinets. We are in over 20 states. We started in the tri-state area. Everybody originated from here, and now they're branching out all over the place. We also do the tax returns for 90% of those people on a yearly basis. That makes us one of the, by the way, the largest private investment firms in the state of New York. Now, lastly, the most fun that I'm going to have tonight, let me introduce you to my wife, my partner, and I'd like to welcome you to the floor for the presentation, Deborah DiMatteo.
Well, welcome everyone. And it is, as I look around the room this evening and made my way around the grounds outdoors, I have to remind myself that I'm at work. I see families, I see stories, I see achievements, I see disappointments, children, things that we have been through together for a lot of years for many of us. So it's just such an honor to be up here tonight. So before I start, I would also like to personally thank my staff. They make not only this look easy, but we take care of hundreds of families every day, and they make it look really easy. And I do want to take a minute to also thank my advisors. Mike and I challenge them every week with really 2 jobs. First and most importantly, to make sure that they are educated and up to date to keep you as aware as possible of everything that's going on out there to help you understand what's going on in your accounts. But probably just as importantly, we make sure that they continue to instill what we consider the culture of 1015 Associates. And looking around the room tonight, I can tell they're doing a great job. So I want to thank them for that. I would also like to thank want to thank my husband. And for those of you that know us, you know he's my greatest fan. And what you probably don't understand is that without him, not one of us would be here this evening. 1015 Associates was his brainchild 30 years ago. And we're all getting to enjoy the ride. So thank you very much. So I don't have a funny story to start this evening, but I will take 2 minutes of, I'll call it personal airtime up here tonight before I start. I've got a lot of ground to cover. And as you know, Mike and I have raised 3 children, and we've always liked to think that we treat them equally. And notice I didn't say fairly, but equally. And so I don't want to leave anybody out tonight. My son was introduced. You've also gotten to know Stephanie. And we have our 3rd child here this evening. And she's going to kill me, but will you please stand up? It's really special to have Michelle here with us tonight. She has lived down in North Carolina for the last 5 years and has recently come back to New York. So, welcome home. She loves us. So, anyway, I'm going to get started this evening. As usual, I've got a lot of information to cover. For those of you who are not familiar with our agenda, we're going to talk about words that we learned, where we've been, where we are, and most importantly, probably what we should be paying attention to. So words we learned. This is what I call our trivia session. We've been all outside enjoying a gorgeous New York summer evening and had plenty to eat and drink, hopefully. So I want to get your minds going before I get into some of the heavy details. So what is the polar vortex? A clothing line specializing in cold weather gear, an evil group of polar bears set to attack the United States from Canada, or a massive, brutally cold air system that descended on the United States this winter. If you picked C, you're correct. The difficult thing about this weather pattern, it basically covered the entire United States. We're going to talk about that this evening. How about ISIS? An abbreviation used in messaging for ICIC, a character's name in the new upcoming Star Wars movie, or an acronym for the Islamic State of Iraq and Syria, a friendly group that has made the headlines quite often this year. How about gamification? A complex scientific procedure where particles are broken down into new elements, new techniques used at the beauty parlors to enhance a person's attractiveness, or a concept spreading like wildfire where educators and companies apply game-like design thinking to non-game applications. C is correct. You're not going to have me turn on your cell phones, but we have technology everywhere today, and now it is intruding in all parts of our life. So let's talk about where we've been so far. When we got together in January of this year, we were still cautiously optimistic about where the market would go. And so far we know we're halfway through the year. The S&P 500 is up 6. 10-year Treasury rates sit at 2.5%. The international markets are up 3.7%. Gold has staged a rally this year, up 9%. And the VIX, or the volatility index, is down 20% this year. Let's go back and take a look at what the experts were telling us to set us up for the year back in January. Now a very familiar face, our new Fed chairperson, Janet Yellen, in December of 2013, came out and said that the economies in the United States were going to grow by between 2.8 to 3.2%, and we would have no negative quarters. She was a little bit off. The first quarter, our economy contracted by almost 3%, putting her 6% off the mark, or a miss by almost $1 trillion in economic activity. It also marks the 16th consecutive quarter that the Federal Reserve got it wrong. What were the Wall Street experts telling us? As we came into the year, we were following one of the best years that we had in decades. And the analysts were anywhere from about a 0.2 return on the S&P 500 to a 12% return by the end of this year. We're halfway there. We're halfway to Thomas Lee, who has actually been very good the last couple of years at calling where the market is headed. But we got 6 more long months before we end the year to find out where this will actually end up. Interest rates, and we're going to talk about interest rates a lot this evening. When we came into the year and we polled those who watched 30-year mortgages, the estimates were that mortgage rates this year would end up somewhere just south of 5% or slightly north of 5%. June 30th, 30-year mortgage rates, 4%. Bill Gross, and he's been all over the news, and we did talk about him last year. Bill Gross manages one of the largest bond portfolios in the world. He's really considered one of the gurus out there, and he's been getting it all wrong. The last year and a half or so, he's totally off the mark, and he's had massive, massive outflows of monies from his funds. Well, Bill Gross told us at the beginning of the year that interest rates would remain low, inflation would remain contained, and that bonds would offer investors very good value. He got it right. One of the very few, and since he had been so wrong, everybody looked at him like he had 3 heads. So, let's talk about that polar vortex. One of the most difficult things in the market and the economy, never mind our own personal lives, that we were dealing with was the deep freeze that the entire country was under during the first part of this year. And the trouble with this is that historically, there is a direct correlation between the weather in the first quarter and the economic performance of the first quarter. When you have economists and the Federal Reserve, when the Fed chair was testifying before Congress early this year, it sounded more like a national weather report than an economic report because nobody could figure out how much the weather would impact this economy. What we do know is it was the 25th coldest winter in history. And if you look at that chart over on the right-hand side, the line chart, that is the average temperature over the last several years. The red bar chart is GDP. So what that equated to is the 25th coldest winter, the 17th worst quarter in economic history. Weather does matter. The question for all economists during this period is how much and will we get it back at some point? This is a scary statistic. If you look at the top 25 worst quarters in history, every time that we have posted a quarter of negative 1.7 or worse, our economy's been or gone into a recession. Every other time. So we're a negative 290 in the first quarter. So what's the definition of a recession? 2 consecutive quarters of negative GDP. And I love economists. You know, they call it a science, right? So they'll tell us 2 quarters from now, oh yeah, we were in a recession. I'd like to find somebody who can tell us when we will go into one. So we look at this, we can tell you it's not all bad news. Every time in the past 25 that we've had those negative quarters, 12 months later, there is an 80% probability that the market will go higher. And it will move higher by an average of 16%. So, good news, bad news. So we haven't gotten second quarter GDP numbers, so I can't tell you whether in fact we're been in a recession behind us or not. But certainly it doesn't mean that it's doom and gloom for the stock market yet. Last time when we met, we talked about the transition of a new Federal Reserve. We had the Federal Reserve and the outgoing Federal Reserve roil the markets last year, telling us that the economy was getting good enough that they were going to start to take away stimulus. We assumed that Janet Yellen would be very Bernanke-esque, that she would follow through the policies outlined by the outgoing Fed chair. What we know now, that first part of the chart there, right now in 2013, 2014, the Fed has continued its tapering program. We talked last time about what tapering is. It means that they're buying less bonds, supporting the economy a little bit less. Although we have seen weak economic numbers, the Fed chairwoman just told us last week they will end this program by October of this year, that they will stop tapering. The important thing about this is the Fed is still very active in the economy. I mean, they're taking away some, but they're still buying billions of dollars of bonds every single month. And it's going to be a long time. She's just testified the last 2 days. The Fed has absolutely no reason that they think that they need to actually raise interest rates anytime soon. That's one of the reasons that we can attribute to the fact that this bull market continues to go on. Right now, we've got an accommodative Fed. We've got interest rates that remain stubbornly low, meaning that bonds are not a competitive force to the stock market, and money will find its way to the most productive asset class. And for the first time since the recession that we went through, investor sentiment is finally starting to turn positive. Now, that can be a contrarian indicator, though. You know, I was talking to people even beforehand. You know, we've traveled 10,000, almost 11,000 points from the bottom, and people still don't believe that there's a recovery out there. And so we've got this massive recovery in the markets, and investors are just finally now starting to buy into the idea that maybe I should be dipping my toes into the water. That can be a contrarian indicator. So we started out the year, came off a phenomenal 2013. January 2014, the market starts to tank. So what do all the professionals tell us? This is a big one. Get ready. It's going down. This is the one we've been waiting for, 15 or 20% correction. And what happened in February? We got it all back. We grinded sideways for a little while, and we are off to the races. And still, once again, if you didn't see the close of the market, we did close at record highs in the Dow and the S&P both today. So we continue to see this market go higher. Now, the interesting thing about 2014 is the fact that the bond market has also been very profitable. This fits right into our wheelhouse. When we can have both sides of your portfolio performing at the same time, this is a great world for us. And it's typical usually that if the stock market is doing well, the bond market is not, and vice versa. Well, we've had one heck of a first half because we've got both sides of the portfolio working at the same time. We came into 2014 and all estimates were that interest rates were going to go higher, get out of the bond market. It's not a good place to be. Lo and behold, interest rates have declined. Bond prices have risen, and bonds have been a very good place to be in 2014 so far. I'm going to walk you through this chart. And I promise for those of you who are new here, there won't be a quiz at the end. But I am going to try to get you to focus on a couple of things because I'm going to reference these numbers again a little bit later. Because this is a very, very telling chart. The green line, and if I can work my thing. The green line there, you see that massive drop. This chart starts January of 2008. You see that massive decline, the one that many of us grew a lot of gray hair during. S&P drops off, and then it goes on and recovers up to June of 2014. The yellow line, I guess it was yellow, looks kind of mustard to me on here. The yellow line, that represents high yield, or what we call junk bonds. The junk bond market also dropped off quite dramatically in 2008. Remember, there was nowhere to hide. Bond market dropped off, and then you see the massive progression, and look at that. Junk bonds have actually outperformed the stock market from January of 2008 to current. The line I really want to focus on, though, is that peach kind of pink line there. Also drops off in 08. Those are investment grade bonds. That's what we buy. Corporate bonds issued by companies that are not perceived as high risk. Well, they also dropped in 2008, just not as much as everything else, but it was still very painful. And then they rose. It's right here that I want you to look at. This area here, that's the middle of last year, when the Fed decided to tell us, I'm going to step away, and the whole world turned upside down, and interest rates started to rise, and the bond market tanked. That was June through August of last year. And that's why the outcry was, get out of the bond market, rates are just going to continue to go up, and that would be the story for 2014. Enter January, January of 2014, and we see the recovery. And all those bonds, they start to go back up in value. But here's the important part. I can't find that. There it is. See right here? The blue line and the pink line kind of work in tandem for all those years. I want to make sure everybody gets this. They go down together, but at the very back end of that chart, and this will be important later, that pink line diverges significantly from the blue line, which are treasuries. Corporate bonds have been on an absolute tear this year. Our Federal Reserve was so presumptuous as to tell the world that she believes certain parts of the bond market are overvalued. Okay? So I know this seems like a lot of mumbo jumbo, but that move in the corporate bond market so far in the first 6 months of this year has some significance to where values are stretched in this market and has implications on what decisions that we're making in your portfolio. So now that I've totally bored you with some statistics, let's take a quick break.
Peter, come take a look at this. Mr. Daniels.
Look at this.
What's this? The numbers, they keep getting bigger and bigger.
Clicks are off the charts.
Yeah.
Yoshi, it's Walter. We're back.
Yes, sir!
More shifting! I need more trees! More trees? I'll get you more trees!
Hey, take a look at wood pulp.
Everything you got on wood pulp right now.
He really loves that thing.
My version of day trading. Okay, we just need a little break there. All right, so where are we now? Let's talk about inflation. And I think a conversation with inflation really needs to be preset with what the expectations are out there. The Federal Reserve has an inflation target, and they believe that they would like to have inflation not too hot, not too cold. 2% would be just right. And as long as inflation runs under 2%, they feel that they've got the room to keep adding stimulus to the economy. So we can see we're way down there below 2%. Notice the spike up at the back end of the chart, that in 14 we've seen a little bit of spike. Janet Yellen is very, very comfortable, though, that things are not getting heated up. Inflation is very well contained. I want to talk to you about two things with regards to inflation. We will not get sustained inflation in this country until we have wage inflation. Since 2007, that first bar chart there on the left, wages are basically flat. And for those of you who are working, who are family working out there, there's no raises, there's no bonuses, there's no overtime, they're cutting benefits. It's not a nice world for the working class. If people don't have more money to spend, we don't get pressure on prices. But I want you to look at this bar chart here, because everything is about expectations. That first bar chart is about wages and salaries. The light blue line is we polled CFOs, I didn't do this personally, polled CFOs in 2013, do you expect to pay higher wages? Definitively yes. 2014 is the blue line, much higher. There's more people that feel that they're going to have to pay higher wages. I want you to skip to the far right, the bar chart on the far right. That's employment. Do you expect to hire more people? 2013, yes, they did. 2014, yeah, we think we're going to really have to start bringing people back. We are seeing that in the employment numbers. But the chart that I want you to look at is the one in the middle. It's really important. Do you expect to raise prices to your customers? A lot of big yeses there. This becomes the first bleed through of inflation when companies finally feel that they have pricing power. They now think that they're in a position that they can or that they need to raise prices to you. That can become the beginning of inflation. Let's talk about the housing market. We can't talk about where we are without discussing what's going on in housing. See that far bar chart, that's actually May of 2014. 500, largest number of new homes sold since 1992, certainly an uptick in the housing market. We got off to a weak start in early January. We had a big spike. The hit to the housing market during 2008 and 2009 in this country was nothing short of profound. And if we really start to see a recovery in the housing market, it could definitely read through to better economic times ahead. So what's going on in the housing market has significant implications. We can definitely see signs of strength in the consumer in the automobile market. In May alone, we sold 1.6 million vehicles in the United States. We're on track to do over 16 million vehicles. We're actually at 8.1 as of June 30th of 2014. Let me put that number in perspective. That means for the first 6 months of this year, we sold 45,000 cars a day. That works out to almost 1,900 cars an hour, or 31 cars a minute. That's not an economy that's in a crisis, and it's certainly not an economy that's in a recession. There is a real recovery going on out there, at least in certain sectors of this economy. There's a lot of volatility in that number, but if you look at the top line, that's your seasonally adjusted rate, pretty level. Where did we see the drop-off? January, February. Deep freeze, polar vortex. People weren't out buying cars, but it recovered quickly as the weather started to recover. We said last time we met, it's all about the jobs. And we have seen, and let's talk about the good news, let's talk about some of the ugly stuff that's going on in there. It is right now the first time that we've had 4 consecutive, make it 5 consecutive months as of June. First time we've had 5 consecutive months of over 200,000 jobs created in this country since the late 1990s. When we met in January, we were all concerned about right there. December, January, we had a huge drop-off in the jobs number. The question in January was, were the 200,000 or so that we were getting, was that the anomaly, or was the drop-off the anomaly? Well, it's starting to show up that we're getting consistently 200,000 jobs. Now, there's a lot of noise around this number, and there's a lot of things that are very concerning within this number. Look, we all know these aren't great jobs, right? These aren't high level, even middle management jobs. But remember, it's not that long ago in this country, you couldn't even find the burger flipper job. So we can argue the quality of the jobs. I think something that's very concerning to me that came through in the most recent June figure, we did 288,000 jobs. Do you know underneath that in this economy, we actually lost 300,000 full-time jobs. We created 500,000 part-time jobs. That's a problem. And I don't want to talk about politics or some of the reasons that that's happening, but I think that there's certainly a move in this country for companies that have the ability to avoid having to provide health care for their employees. So those who were sold a bill of goods that you will have health care, they don't have health care and they lost their full-time job. That's not a good situation. So we can cheer, some of the headline numbers, but there is some underlying concerns there. And I think one of the hardest parts for us in managing money is we've had this massive financial recovery. And we look at our portfolios and you got Wall Street high-fiving out there. The reality is the working class in this country is still having a very, very hard time. And that's something we're very conscious of. We talked about stock valuation last time. And our stock's overvalued. And they were overvalued at the end of last year when we met. Well, the market continues to climb, and it's climbing at a faster pace than earnings are growing. So yeah, stocks are valued higher than they were historically. We know they're trading at above average valuations. But here's the thing. You can't look at any number in a vacuum. Why are stocks valued? Investors are becoming more optimistic of companies' ability to produce profits. We are starting to feel a little bit better. There is a heel going on in this country. But I think one of the real issues, it's all about our relative choices. With bond yields where they are, remember I went into that long discussion of bond yields, with bond yields where they are, stocks still offer good value relative to bonds. So this is a chart of PE ratios. So we're a little above norm. Normal is 13 to 14. We're trading 15 to 16 times earnings. That's not crazy. Look at back in 1999 to 2000. You guys remember that, right? The tech bubble, way up here. My goodness, 25 times earnings. We were buying tech companies that never even had the potential of ever producing a profit, and we were paying up for them. We were paying 70 and 80 times earnings for companies like Intel and Cisco. And we're getting all, crazy about the fact that we're paying 14 or 15 times earnings. So valuations are high, but there's certainly not a speculative tone to this market in any way when we look at stock valuations. All right, we're going to talk about bond spreads. This is a little bit of a complex topic, but I'm sure you guys are going to get this. And I think it's really important to understand it because as fixed income investors and as managing fixed income for you, we will always have exposure to the bond market. So I want to talk to you a little bit of what bond spreads and what's going on out there. Bond spreads, and let me explain this as the risk premium. How much do we make over and above the underlying treasury? So we know that corporate bonds are offering the smallest spread over treasuries in history. I'm going to help you understand what that means because it will have significant implications to where we're investing our monies over the next 12 to 18 months. So investors are not getting paid much for the potential of taking risk. So let me try to explain this in the context of what we've actually seen happen. Now, first of all, let's go back to January of last year when we met, right? Interest rates were going to keep going up and that bonds were going to fall apart and we were going to have this great rotation of money coming out of the stock market and into bonds. And that hasn't happened. So go back to 2001, the period from 2001 to 2007. And this is showing that how much are we compensated above the underlying treasury. So let me give you an example. Back in 2001, 2002, 10-year treasury rates may be averaging around 4%. We buy you a corporate bond. We get about 1.5 points. That's a long-term average. 1.5 points above that underlying treasury. So we could buy you bonds for 5, 5.5, 6%. That all makes sense, right? So you're risk-free. The government can always pay you back. The risk premium says, I want more money because I'm taking risk that this company might not be able to pay me back. So that long-term average, 2001, 2007, everything's going completely fine. Enter the financial crisis. There we are up there. So you see that 6.6? Interest rates didn't go up, but we had the ability to go out there and buy you corporate bonds. I remember two names specifically that may ring a bell, Verizon and IBM bonds, 7 and 8% interest rates. The underlying treasury was at 2%, but we were able to buy a bond for you that was paying 8% because everyone was afraid to lend money to anyone. Risk premium. So we were getting highly compensated to make those loans. Where are we today? Risk premiums have collapsed. Interest rates have remained low. So the underlying treasury is at 2%. Our risk premium, less than 1%. So the treasury is at 2%. You buy a bond, you're going to get maybe 3, 3.5%. I call that no meat on the bones. So when we look at valuations, we can certainly make an argument that stocks are highly valued, PE ratios are a little bit elevated. But what about our bonds? Historically low interest rates with no meat on the bones, okay? That's something we have to be paying attention to in the back half of this year. And remember that pink line? Corporate bonds, no more risk premium, okay? That all makes sense now, right? Okay. All right. Vanishing, these are just the things that, I spend my free time thinking about. Vanishing volatility. One of the things that we got used to over the last several years is the massive volatility, and none of us liked it, right? The market was swinging 300, 400, 500 points. I remember worse days than that. We all looked forward to days where we could kind of watch the paint dry and that the market would just kind of meander a couple of points every day. And we've been doing a lot of watching the paint dry here in the last couple of months. Volatility has all but disappeared in 2014. Early, we had the Russian crisis start to emerge in January, February. Volatility spiked up, and now there's no more volatility. Why is this an issue? Lack of volatility. Oh, that was a nice song. Lack of volatility is an indication of complacency. So there's a fear that traders right now are not giving enough respect to some of the risks that are out there. So we don't like those huge swings, but then everybody worries about the fact when it's not swinging enough. So there's just no happy medium out there in the marketplace. So what are we going to have to pay attention to? I'll give you my top 5, and they're maybe not in this order. Inflation, the central banks, geopolitical tensions, the use of corporate cash, and the elections. So let's start with inflation. And we talked about it a little bit, talked about the Fed targets on inflation. Inflation is finally becoming a mainstream conversation in the marketplace today. And the issue is, who's got it right? Wall Street continues to believe that the economic recovery will continue to take hold and that the economy is going to start to grow at 3 to 4%, and with that will come inflation. The Federal Reserve tells us the economy is doing fine, but don't worry about it, there's not any inflation out there. And then those of us, I say, who live in the real world, who actually buy goods and services and buy groceries and fill up our tank, we believe inflation is already out there. So let's take a look at what everybody's predicting. The Fed, we're well under 2 and we're not even worried about it. The economists has finally started to ratchet up their expectations a little bit because they've seen the jump in the CPI. Inflation for us, we can say it's age-based and income-based. Those at the lower income, there's 50,000 is that middle, the third golden line there. People who are of lower income perceive inflation higher because a greater percentage of their discretionary income is spent on things that are highly subject to high price swings. The older we are, the more we perceive inflation as a problem because you are either at or near fixed income. So again, a greater percentage of your income will be subject to the pressures of inflation. Another messy chart, I only wanted to look at one thing. This is that green line in there, or the darker line in there, represents the 3-month change of inflation on an annualized basis. There's only one thing I want to draw your attention to, the very back end of that line. See that big spike? That's the first quarter of 2014. The Federal Reserve just testified and she said, it's just noise. This is how it feels to us out there. Utility bills go higher, our gasoline bills go higher, healthcare costs go higher. Everything that we buy on a regular basis is running away, and what are wages doing? Nothing. That is certainly, so why is inflation such a big deal? Look, when prices go up and we have less discretionary income, that hurts the economy. If companies have to start paying higher wages, that hurts profits, which will hurt the stock market, which will hurt the wealth effect, which will hurt the economy. It is a death spiral that we just don't want to see. Inflation is something we have to be highly conscious of the effects and what could happen. I won't get into a lot of detail, but on the top of the line in the middle, that gray or black line on top, those are the things that are positively affecting inflation. Child care, vehicle maintenance, food and beverages, health care, the things that we spend money on regularly. Well, in the government formula, see that big drop? TVs, cell phones, computers. We don't buy those every day, but they put that in their formula. They have a drop in the cost of housing built into their formula. They use rentals. So it is a very skewed formula, and everybody's beginning to worry, and I've been worried about inflation for a while, wrongly so, but everybody's beginning to worry that the Fed's looking over here and looking over here, but meanwhile we got a big problem brewing over there. Inflation is something we need to pay attention to. We need to watch the central banks. And it's no longer just our central bank that we need to pay attention to. Central banks around the world, they're not concerned about inflation either. And in an unprecedented move, the European Central Bank has gone to negative interest rates. They are so aggressive right now, it actually costs money for institutions to keep deposits, that they want their institutions, their banks, to start lending money more aggressively or moving assets to riskier classes. This has significant implications. Nobody can understand why 10-year Treasury rates are still sitting at 2.5% if the economy is actually doing a lot better. Well, guess what? For the first time in 15 years, German Bund rates are lower than U.S. Treasury rates. We've got the safest currency in the world, and we're paying a higher interest rate than Germany is. Well, guess what? It's not just U.S. buyers. We got worldwide buyers flocking into our Treasury bonds, compressing U.S. interest rates lower and longer than any of us would have guessed that we'd have these low interest rates. It complicates the exit plan. Because at what point, if all that money starts to leave, Do we get a reversal in this? So following what central bankers around the world has significant implications. The problem that I have with this is that quantitative easing across the globe has not resulted in real great economic results, right? Japan has had a zero interest rate policy for nearly a decade. They're still printing money as fast as they possibly can. We got Bernanke and now Yellen. We'll do zero, we'll print, we'll do everything that we can. And yet we continue to downgrade growth estimates. We're going to do all this in 2013. Everybody's optimistic. The economy's going to start growing at 3 or 4%. And as we move through the year, they downgraded it, downgraded, downgraded. Well, 2012, same thing. 12, 13, and now 14. Remember Janet Yellen? 2.8 to 3.2? Guess what? We're downgrading those forecasts as we talk. So we keep on doing the same thing. Everybody's following it, and it's this follow the leader mentality that's really disturbing to me. You know, if they've been doing it for 10 years and it's not working, and now we're doing it and the Europeans are copying us, that really makes a lot of sense, right? Nobody's getting the expected result, yet we're all following suit. It kind of reminds me, many years ago, I went to the Grand Canyon. And the group that I was traveling with, we decided that we would take the donkey ride down into the canyon. And so I didn't realize that it was early in the season, you know, springtime. We were one of the first trips of the season to board on our pack mules and, you know, go on down into the canyon. Well, I was lucky enough to be part of this group that the lead donkey jumped off the cliff. So what do donkeys do, right? Follow the leader. So we were lucky enough to abandon our donkeys, and we pulled, the lead guy got caught up in a tree, and we pulled them up over the side of the cliff. I sat there thinking to myself, who's the stupid one? I'm sitting on the back of a jackass riding down the side of the biggest cliff in the world. It's kind of like the central banks. That's monetary theory. You know, throw it out the window, cross your fingers, and hope that it works. So this is certainly concerning in a lot of ways. Geopolitical tensions. I don't need to belabor this point. You guys know what the issues are out there. We got the Iraq-Iran issues, roiling the oil markets, oil over $100 a barrel in this country. We're producing more than we ever had, yet we're paying for it dearly at the pumps because some of the problems going on outside the world. We also had earlier on this year, Russia flexing their muscle with the annexation of Crimea. Geopolitical tensions are something we deal with every year, year in, year out. They're different, they change, and for the most part, they are just headline risks. The problem is we never know when they turn into an economic event. If suddenly oil is $130 or $140 a barrel, that now begins to become an economic event. So it's something we need to pay attention to. It is typically not something that changes our investment strategy. Corporate cash. We talked a lot in January about the mountains of money that corporations are sitting on and what implications that this could have. Well, we know now what they're doing with some of it. As of the first half of 2014, we have had $800 billion of mergers and acquisitions. We're only halfway through the year. We will easily exceed all of the mergers and acquisitions activity that went on in 2007. There was just a big deal announced this morning, $80 billion deal. It was squashed, but we're seeing it in all industries, across all different sizes of companies. This does put a bid into the stock market. It's good for stocks. It does not create one job. If anything, it will hurt jobs. But companies are spending their money buying other companies. We also know that they are repurchasing their own shares. In the first quarter of this year, we had a record $160 billion of share repurchases. Pat your wallet because that helps us. When companies buy back their shares, there's less of them out there. It allows them to show better earnings, and we own a greater percentage of the company. Once again, this is great for us. This is good for Wall Street, but it doesn't do a darn thing for the economy. We know we peaked out, we had about $1.4 trillion of corporate cash on the balance sheets at the end of last year. They have only dipped their toe in spending some of this money. We're still over $1.3 billion of cash that they have to spend. We expect we'll continue to see more mergers. We'll continue to see more share repurchases. There were several announced just as early as this week with the earnings season starting to heat up. We would expect that companies will continue to raise dividends. This has been a bonanza for our portfolios. We own dividend-paying stocks. Workers out there are getting no raises. Companies across the board who pay dividends, I'd say on average we're sitting on a 12 to 14% pay raise for the 2014 year based on the dividend raises that we've got. Maybe 2014 will turn into a year that these companies will get the novel idea of maybe starting some new projects, paying higher wages, and hiring more people. They've got the cash to do it. It is an election year. And we know right now that the midterm elections will be critical. They could be critical. If the Republicans gain 6 seats in the House and maintain 6 seats in the Senate and maintain control of the House, it would change the dynamics in Washington a lot. That could have some significant impact on the market in the next couple of years. So obviously we have a lot of things that will be keeping us busy over the back half of this year in watching what we do with the portfolios. I have a short video that I'm going to play to close up, but I'd just like to make a couple of closing remarks before I begin the video. We remain positive on these markets. I think more importantly, we remain extremely conscious and very respectful of the fact that we are statistically long overdue for some sort of correction in this market. You never see it coming, you never know what's going to trip it, but it's certainly out there. And I think it's literally impossible to be able to predict in the very short term the direction and the magnitude and the timing of any short moves in these markets. So to think that we have the ability to step aside and then be smart enough to get back in just when the time is right, that's a fool's game. But what I will tell you is that what we consider our core competencies that have gotten us here this far as of right now, and we consider those patience, have a strategy, and probably most importantly, be willing to execute. When Mike introduced me as your portfolio manager, one of the hardest things that we do is make decisions because they usually don't feel good. You have to buy when nobody else wants to buy, and you have to be willing to sell before most people are willing to get out. Those are our core competencies. They got us here. I'm highly confident they'll carry us well into the future. So we're prepared. We know it's out there. We got this great high in the market. It would be nice if we could just enjoy it for a little bit. But we do remain optimistic in the longer term of this market. So I'm going to close with a quick video. And I think it's very timely. It's actually a graduation speech that is from 15 years ago. And it is that time of year, graduation season. And when I saw this video, I just felt that it's something that will probably touch each and every one of you in this room in some way. And so thank you for being here. Stephanie mentioned to our guest this evening to see Laura. I'll also like to mention on your chairs there is a brochure. I'll give credit to Stephanie. It's a new marketing piece. We'd ask that you take those with you. It is the ability for you to extend an offer to someone that you know that you feel may benefit from the services of 1015 Associates, to extend an offer for one of them to come in to see us. We grow by your help, and it means a lot to us. So if you take those with you this evening. Otherwise, thank you very much for coming. I'll leave you with these parting thoughts.
Ladies and gentlemen of the class of 99, wear sunscreen. If I could offer you only one tip for the future, sunscreen would be it. The long-term benefits of sunscreen have been proved by scientists, whereas the rest of my advice has no basis more reliable than my own meandering experience. I will dispense this advice now. Enjoy the power and beauty of your youth. Oh, never mind. You will not understand the power and beauty of your youth until they've faded. But trust me, in 20 years, you'll look back at photos of yourself and recall in a way you can't grasp now how much possibility lay before you and how fabulous you really looked. You are not as fat as you imagine. Don't worry about the future, or worry, but know that worrying is as effective as trying to solve an algebra equation by chewing bubblegum. The real troubles in your life are apt to be things that never crossed your worried mind, the kind that blindsides you at 4 p.m. on some idle Tuesday. Do one thing every day that scares you. Sing. Don't be reckless with other people's hearts. Don't put up with people who are reckless with yours. Floss. Don't waste your time on jealousy. Sometimes you're ahead, sometimes you're behind. The race is long, and in the end, it's only with yourself. Remember compliments you receive. Forget the insults. If you succeed in doing this, tell me how. Keep your old love letters. Throw away your old bank statements. Stretch. Don't feel guilty if you don't know what you want to do with your life. The most interesting people I know didn't know at 22 what they wanted to do with their lives. Some of the most interesting 40-year-olds I know still don't. Get plenty of calcium. Be kind to your knees. You'll miss them when they're gone. Maybe you'll marry, maybe you won't. Maybe you'll have children, maybe you won't. Maybe you'll divorce at 40. Maybe you'll dance the funky chicken on your 75th wedding anniversary. Whatever you do, don't congratulate yourself too much, or berate yourself either. Your choices are half chance. So are everybody else's. Enjoy your body. Use it every way you can. Don't be afraid of it or what other people think of it. It's the greatest instrument you'll ever own. Dance. Even if you have nowhere to do it but in your own living room. Read the directions, even if you don't follow them. Do not read beauty magazines. They will only make you feel ugly. Get to know your parents. You never know when they'll be gone for good. Be nice to your siblings. They're your best link to your past and the people most likely to stick with you in the future. Understand that friends come and go, but with a precious few, you should hold on. Work hard to bridge the gaps in geography and lifestyle, because the older you get, the more you need the people you knew when you were young. Live in New York City once, but leave before it makes you hard. Live in Northern California once, but leave before it makes you soft. Travel. Accept certain inalienable truths. Prices will rise, politicians will philander, you too will get old. And when you do, you'll fantasize that when you were young, prices were reasonable, politicians were noble, and children respected their elders. Respect your elders. Don't expect anyone else to support you. Maybe you have a trust fund. Maybe you'll have a wealthy spouse. But you never know when either one might run out. Don't mess too much with your hair, or by the time you're 40, it will look 85. Be careful whose advice you buy, but be patient with those who supply it. Advice is a form of nostalgia. Dispensing it is a way of fishing the past from the disposal, wiping it off, painting over the ugly parts, and recycling it for more than it's worth. But trust me, I'm the sunscreen.